On this $320,000 mortgage, paying $3,200 upfront cuts the illustrated payment by about $105 a month. Useful deal or expensive shortcut? The answer is one number: break even. I'm Don Ledger. Let's follow the numbers. Today, mortgage points, the one line on your loan estimate that quietly changes your rate. For the Garcias, that's a $320,000 decision. Pay points now or keep the cash. We'll break down the math so you can decide with confidence. Meet the Garcias. First-time buyers with $80,000 saved for a 20% down payment on a $400,000 home. They're looking at a 30-year fixed mortgage at 6.65%. Their lender offers discount points. These are prepaid interest that buy down your rate. 1 point equals 1% of the loan amount. On a $320,000 loan, their baseline payment is $2,054 a month. That's principal and interest only. No taxes, insurance, or HOA fees. Now, should they pay points to lower that rate? Or keep the cash for something else? That's the real question, and the answer is a simple math comparison. In this illustrative lender quote, 1 point lowers the rate from 6.65% to 6.15%. The payment falls about $105 a month, while the point costs $3,200 up front. The loan estimate, which you get within 3 business days, shows the rate and points side by side. Compare it to the closing disclosure before you sign, because that's your last chance to catch a change. The key question: how long will you stay? If you leave before the break-even, points don't pay off. Let's see the math. Now we run the numbers. Same $320,000 loan, same 30-year term. 3 paths: buy 1 point, buy 2 points, or skip points and put more money down. Baseline: 6.65% rate, no points. Monthly principal and interest, $2,054. Total interest over 30 years, $419,544. That's the number we're trying to beat. In this worked quote, 1 point costs $3,200 and the assumed rate is 6.15%. Monthly principal and interest fall to $1,949.53, a saving of $104.76. Divide the $3,200 cost by $104.76 in monthly savings. The illustrative break-even is 30.55 months, roughly 2.5 years. Now use an illustrative 2-point quote: $6,400 upfront, a 5.65% assumed rate, and a $1,847.15 monthly payment. That is $207.14 below baseline. Instead, put the same $6,400 toward the down payment. The loan becomes $313,600. At the same 6.65% rate, principal and interest are $2,013.20, saving $41.09 a month. Over 30 years, the illustrative 2-point quote reduces total interest by $74,570.40. Using the same $6,400 as extra down reduces it by $8,392.40. That gap comes from the assumed rate change, not from points having a fixed value. There is also opportunity cost. At a hypothetical 7% annual return, $6,400 compounds to about $48,700 over 30 years before taxes and volatility. That is an assumption, not a promised outcome. The larger down payment has no break-even. You save $41 a month from day one, but you also lose the chance to invest that $6,400. It's a trade-off. So, 1 point saves $105 a month, 2 points save $207, and a larger down payment saves $41. But points cost cash up front. Which is right for the Garcias? That depends on how long they stay and what else they do with the money. Now we lay out the Garcias' choice on a single grid. 3 paths, 1 clear question. Where does the cash work hardest? For the illustrative 1-point quote, $3,200 divided by $104.76 in monthly savings gives a 30.55-month break-even. Treat that as a quote-specific calculation, not a universal rule. Use the same $6,400 as extra down instead. The payment falls by $41.09 immediately, and total interest falls by $8,392.40. There is no waiting period, but the monthly saving is much smaller than the illustrative points quote. Keeping the cash preserves liquidity and may earn interest, but the result depends on the actual return, taxes, risk, and when you need the money. Compare those assumptions against the documented monthly saving. Mortgage points may be deductible, but the timing depends on IRS conditions. Some points are deducted over the life of the loan. Full deduction in the year paid requires specific tests and itemizing. Check publication 936 or a tax professional. The Garcias expect to keep the mortgage for 10 years or 120 months. The illustrative 1-point break-even is about 31 months. If they refinance, sell, or pay off the loan before month 31, the points may not recover their cost. So the rule: if you'll stay past the break-even, points can be a smart prepaid interest. If not, that cash belongs in a down payment or savings. It's a budget test, not a guess. The Garcias decision isn't about rates alone, it's about time, cash, and what that money could do elsewhere. Next, we'll turn this into a simple checklist you can use today. Decision rule: keep the mortgage beyond the quote-specific break-even and protect your cash reserve. For this worked example, that threshold is about 31 months, not 5 years. Next, compare at least 3 loan estimates. Put the rate, APR, points, lender fees, and cash to close side by side. Freddie Mac reports that additional quotes can save borrowers money over the life of the loan. Then do the math yourself. Take the points cost, divide by the monthly savings. That's your break-even in months. If it's longer than you'll stay, skip the points. Ask yourself, how long will you stay? Do you have extra cash for points without draining savings? If you're unsure, a no-points loan keeps your options open. For more, check the CFPB's Mortgage Basics and Freddie Mac's rate data. Links are in the description, with every number in this video sourced and dated. Your next House Money Lab guide is on screen now. Subscribe for clear decisions and read the numbers before you sign.